Hey everyone, Josh and I are back to give you a third quarter update for what's going on both with mortgages and the housing market. And that lovely voice you're going to hear in the background at different times throughout this is Josh's youngest, who he's home with right now. So we all deal with that. So she'll probably be cuter than us throughout the whole movie, throughout the whole time anyway. um,
Yep.
so again, I'm Jay Cottrell with EXP Realty, and this is I'll let him introduce himself.
Yep. Josh Pruitt was here at Pacific Mortgage, located here in the Tri Cities area. So
hmm and just
glad to be back again.
absolutely ignore the date on this slide. I didn't update it. We were supposed to record it earlier, and both of us had something happen, so recorded a few days later. But I did not update the date on the slide. Um, no biggie though, right? So
That's right.
we're going to let Josh start out by giving us a bit of an update on what's going on in the mortgage market. And I told him when we first were prepping, I was like, I love this slide because they act like they can actually predict what rates are going to be. they do have some good ideas from history, but I'll let Josh kind of talk to us about the mortgage side of things.
Yeah. So, obviously, it's been a lot of predictions, that people have been trying to do with this whole rates and what's going on in this industry. And you know what I love the most about it is that even the experts, we always rely on experts, rely on people to give us the best info, but sometimes you just can't predict stuff
Mm-hmm.
and you just have to write it out. And so, everybody was hopeful, but the reality our economy and the market and a lot of things that are going on, kind of at a tough place. And it just kind of is what it is. So, so a lot of people try to predict, kind of rates and what was going to happen and what's going on and all those things. And um, so as you're looking here, we're looking at what about the end of 2023 and Q1, Q2, Q3 of 2024, what are we looking at? And, right now we're still pushing right around 7.9 to 8% on rates. We're still right up there. The good thing that I do see is that I feel like that we may be finally at that stall period where rates are just going to kind of stay where they're at. They're not going to go super high. They're not going to go super low. So what does that mean? That means that, if you are looking to purchase, that now should be an okay time, if you're comfortable with the rate or you can, afford the rate. I know that's a big factor into everything as well right now, but the silver lining is getting closer as we speak.
Yeah.
So, just to give some insight, I had some colleagues go to the Housing Wire conference and, they're believing that June of 2024 is when we should hopefully see some big changes coming as far as rates really looking like they're in the sixes there,
Mm-hmm.
closer to the fives. Now, listen, that's another prediction. So it doesn't mean it's going to happen.
Right.
But, all the factors lining up to that is kind of what we're hoping for. So, but as you can see, we've topped out over 8%, 8 on the rates this year. Um, I know that doesn't even have it up to 8 on that chart, but we did top 8 just a week ago
Mm-hmm.
um, on the national 30-year fixed mortgage or 30-year fixed conventional. So
Yeah, I think that chart's a couple weeks. If I look at I think
yeah,
it's a
yeah,
couple weeks
probably the week
behind.
before.
Yeah, yeah. Well, and I have the conversation with people, a lot as well. That if you can afford the mortgage and the rate right now, you're going to be in a much better financial position, um, most likely to go ahead and purchase now than to wait until
Yeah,
that rate drops down 1% or 2%, because home prices, at least in our area, are still accelerating. They're still going up.
right,
So the difference, the your mortgage payment of buying now and buying in a year or so may not even be different, because the home prices
right,
have gone up, but the rates dropped. But the overall actual change to mortgage payment likely won't be much different. Whereas if you purchase now and then refinance that mortgage in a year, you're going to drop your payment a good bit by
right.
having a 1 or 2% difference. So it's still
And
It's still better to
I
do
can
it now.
attest.
Yeah.
I can attest just seeing rentals that are out there right now. One bedroom, one bath for 1,200 a
Uh-huh.
month is unheard
And
of.
if you want to
I
rent a
mean,
house, like a 3 bedroom house or so, you're closer to
oh
two
yeah,
or more.
2,500.
Yeah.
Yeah,
Yeah. Mortgage isn't going to cost you that much. Or it might cost you the same, but at
right,
least you own the house at this point.
right, right.
So that's just a graphic
Yep.
representation of the previous slide. Um, and so I'll let Josh kind of explain this a little bit further, but the mortgage credit availability index is basically an index that tracks um, how many buyers are actually able to qualify um, for mortgages. So that's what that is. So the higher the index, the more buyers that are qualifying for mortgages. The lower the index, the fewer
Mhm.
home buyers are qualifying for a
Yeah,
mortgage.
and I've seen that with applications and with people wanting to get approved, and I tell them what the rate is, I tell them what they qualify for, and they're kind of shocked, um, and a lot of that's because a lot of people don't understand what all factors go into your debt to income. What are we calculating? What are we using to factor those things? And you add the rate in there, you add taxes and insurance, in which a lot of people don't understand. But on top of that is that insurance has gone up. Where I used to quote
Mm-hmm.
0.4% on insurance for a decent credit, I'm bumping up to point 0.5, point 0.6, point 0.8. Sometimes over. If you're buying a double wide, I'm bumping it up to 1.2% because the insurance on a double wide is
Mm-hmm.
way up there. And then of course taxes. Taxes have gone up because the value in the homes have gone up. So and the property assessors out there having a heyday, going around saying, well, that one doubled in the past 2 years. So, those
Yep.
that are available, now it's a lot tougher now for those who actually qualify. And not to mention that we're dealing with, the economy that we're in. It's tough right now to live, buy groceries, and I'm sure some are probably dealing with having a hard time even paying their bills. Paying credit cards, paying, and credits
Mm-hmm.
being affected. And on top of that, an issue that's always been there is medical bills, right? And especially now, if you've got medical bills, my lord, I mean, it's just a tough time for everybody for sure. So,
Yep. Yeah, and I just saw another thing that they expect uh, health insurance premiums to go up in 2024 as well. I think it was somewhere around total premium for a family was going to be like
geez.
24,000 next year, and that's total for the year. So if you look at that, sorry, I used to work in healthcare. So if you look at that, that's the total cost. So a lot of us, a lot have health, a lot of healthcare sponsored plans. So a big portion of that is covered by the employer. But if you look at the overall cost of what the employee is paying for their family coverage and the employer is paying for family coverage, I think I saw it was going to be like on average 24,000 for health insurance next year. So again, tons of things, tons of things going up in price.
Sorry about that.
You're fine. That's a great thing about doing these not live is I can edit that out.
Yes,
Yeah.
yes.
So yeah, lots of different things going up, and then I mean I know Josh and I both are on the fortunate yet unfortunate. We both drive trucks, and every time I fill that thing up at the gas pump, I just cringe.
Yeah,
Yeah.
yeah.
All right. Any final thoughts on the mortgage market before we move on to real estate?
No, we do have some things coming down the pipeline. So hopefully some things to help with some down payment assistance. Mid-November to late November. I know our company's working on some things. You guys have probably seen out there the 1% down option. Some lenders have put out there. That's going to be an option, and then of course we're looking at one that will help with up to about 3.5% down. It'll be looked at like a second lien, um, but yeah, there's some things coming down the pipeline, to help. So, um, but I do think, we get through quarter four, 2023,
Hmm.
get into Q1. I think going into spring market, I hope spring of 2024 will be the first normal that
Right.
people will start to see. Rates coming down. Obviously, people are going to be buying and selling homes. That's not going anywhere. So, yes,
Yeah.
it's slow right now, but,
And I,
it should pick up.
yeah. And I think we should probably say that, rates going up in the late fall is not anything unusual. Um,
Right,
it's what we
right,
saw happen last year, and sales slowed down, and then after the first year, rates started dropping again. It's what we saw the year before that,
right.
as well. So it's not an unusual thing for rates to kind of peak in the early to late fall.
Agreed.
Uh, so let's move on to real estate. So I want to talk briefly about the national market, but I say briefly because it has some bearing, but it's really the national picture is a whole lot different than what we're seeing here locally. So the dark blue is 2023. So you can see pretty much every month this year nationally, sales have been down from the previous 2 years. They don't have 2019 on here, but I would suspect that they're pretty close to either at or maybe slightly below 2019 sales numbers on a per month basis. And if we look at the months of inventory of homes for sale, again, like a lot of industries, even auto dealers and others, they look at how many months of inventory of cars they have on their lot. We look at how many months of inventory of homes there are in the market. You can see nationally that number has gotten up to about 3 months, which is improved, but you can see that even all the way back in 2019, we were at 3 to 4 months of inventory. So we're kind of back to there, but 6 months is what we can, 5.5 to 6 months is what we consider a balanced market. So anything less than 5.5 months is a seller's market, which means that there are more buyers looking for homes than there are homes to purchase. This is from John Mack, a senior research analyst with John Burns Consulting, and he says from January through August, housing demand stabilized, resulting in relatively stable home prices. By August, national resale home prices fully recovered from the declines experienced in the second half of last year, and they now exceed their April 2022 peak. So that's nationally. Again, I want you to keep in mind that's nationally. Wait till I show you the local number. This is looking at nationally the change in home prices year over year. It's 20 city composite index. You can see way towards the graph where there's a lot smaller change in home prices from a year to 2 years ago, where you can see the peaks were way up there. But what I want you to notice is the bottom of the graph is zero. So nowhere is there negative home prices. So I know people are waiting for home prices. They say we want home prices to drop. There's been some reports of some areas of the country that have seen some negative movement in home prices, but the overall composite and trajectory of the nation has been no price declines experienced at all. Just a lot slower price increases. And so this is what Salma Hep is saying. She says high mortgage rates have slowed additional price surges, with monthly increases returning to seasonal averages. So in other words, home prices are still growing, but they're in line with historical seasonal expectations. And to put this a little bit in perspective for you as well, this is the percent change in home prices across the country over the last 5 years. Nationally, home values have increased 57%. Here in Tennessee, though, that's closer to 76%. So if you've owned a home through that entire 5 year period, you're sitting on a nice chunk of equity that you probably don't realize. And so she I think it's a she, continues on that nevertheless, home prices are still expected to reaccelerate and reach mid-single digit growth rate by the end of the year, according to their latest HPI forecast. And I don't necessarily disagree with that. And the one thing I'll add to that is if mortgage rates, so there's a lot of buyers you saw by that credit availability index. A lot of buyers have been priced out of the market right now. Either they can't afford as much as they could before, which is puts them in a price range they don't want to be in, or they just can't get approved for an amount, period. Um, if rates drop, that credit availability index increases, which will bring more buyers onto the market next year, which is just going to increase home sales and with still limited inventory, which is just going to which is going to push prices higher. And I think I like the way she worded it. It'll re-accelerate home prices. And then last little bit I want to talk about on a national level is the number of foreclosures. So I've heard a few people talking about foreclosures, how big of an effect is that is. There's been some headlines that show that foreclosures are up double from last year. Well, that's true, but I want to put it in perspective. If you look at this graph, okay, foreclosures right now are double than where they were when it was black, which was during the moratorium. But look at how low that is still compared to history. So yes, foreclosures are up, but they're still minimal. They're not making a measurable impact on the market or adding a measurable amount of inventory of homes to the market. So let's move on to the local real estate um, market. So if we look at active listings, those numbers have been going up. Um, and so I have numbers here going all the way back to 2019. And you can see that orange dotted line is the current year, 2023. So you can see that the number of active listings started to decline a little bit at the beginning of the summer, but now as we had finished out the summer, heading into the fall, that active listing count is growing. But you can see there's not a heavy slope to that line, so they're growing, but it's not making a huge growth, and it's just slightly above the 2021 and 2022 numbers, but it has not even recovered back to the 2019 level, which is the dark blue line, and nowhere near what we would consider, again, a balanced market, which is the red line. So, yeah, we are making gains on the number of homes available to purchase, but it's still staying at an extremely low amount. Sold listings have slowed down significantly. You can see that we were pretty much trending around 2019 to 2020 levels until June hit, and then they've kind of taken a nosedive since then, which is about when interest rates started their fast, steady climb. So we are actually below the pre-COVID sales numbers as far as on a monthly basis. And you can see how that's probably going to trend off for the rest of the year, as it has pretty much every year. And then maybe February or March, we'll see that number start climbing up again. But the question there is going to be: is it going to look like the last 3 years, or is it going to look like pre 2019? There's a lot of things that are going to factor in what happens. If you look at pending, so again, if we look at sales, so sales that happened in September likely are homes that went under contract in August or July. So pending gives us sort of a forward-looking look, and you can see the number of pending listings has continued to decline, which makes me think that sales are going to continue to decline as well throughout October and November. New listings, we have been trending lower than pre-COVID numbers. So the reason why that the fewer sales has not resulted in a market increase in the number of homes available to purchase is because the number of new listings coming on the market is below the averages over the past 4 years. So not a ton of people listing their homes for sale right now, and it's pretty obvious why. Most of those, a lot of people were either refinanced or bought homes when mortgage rates were historically low, and they're not really happy about trading that mortgage for a mortgage at the current level, whether they're looking to whatever they do. So there's people that would normally be putting their homes on the market just because they wanted something different or wanted a different area. They're not doing that. They're just they're staying put and hanging on to that super low mortgage rate. And there's actually a trend of people as well that are moving, but since that they have a super low mortgage rate on that house, they're turning that house into a rental property, and then purchasing something else at the higher rate to help pay for both of those mortgages. So if we look at average sales price, you can see while the sales have slowed and the inventory levels have increased, the prices have not decreased, and in fact have not slowed that much for us here locally. So if you want to look at as far as a relationship between national trends and local trends, we tend to follow the national trends by anywhere from 3 to 6 months. So meaning if prices start going down nationally, we won't see that here locally for about 6 months. So there is a little bit of, we're starting to hit that window of where prices really slowed nationally, where they might start hitting us here. But what I wanted to point out is if you look at September, the end of September's numbers, those sales prices were still up 14% from September of last year. So I don't know that that's necessarily a slowing, because we still have a low inventory and we still have plenty of people from other areas of the country trying to move to our area, because even though prices are up 72%, as shown on this graph, over the last 4 years, here we are still more affordable than most other places in the country that somebody could pick to live. And this just kind of gives you another idea of that monthly home price appreciation. This is looking at the median price compared to the previous year. So you can see 12.77%, 6% last month, 10% in July, almost 11% in June. The low was 1.5% in May, compared to the previous May, but still up significantly from the previous year. But this is where I say you can't look at national stuff and predict locally here, because if you look at the national change in home prices, if you look at starting at October, which is where my previous graph started, it went from 8% to 0.9% to 0.6%. Versus us, we went from 15% to 12.7%. So we are not mirroring the national market whatsoever. All right, so we're trying to keep these shorter, and a little bit more relevant. So the bottom line basically is housing market seasonality is returning to normal. By that, I mean the peaks and the valleys that we would see every year during certain seasons. Those are kind of returning back to normal. They had kind of flattened during the pandemic, but now we're starting to see those normal seasonal upswings and downswings in the number of sales, number of homes on the market. So that's a plus, because there's some normality returning. However, the seller's market is still stubbornly persisting. We still have low inventory. Home prices continue to rise, but they are at a slower pace. And what it really appears to be the barrier to sales is mortgage rates. If mortgage rates were lower, we'd have more homes selling, I think, is kind of the bottom line there. What do you think, Josh?
If we have better rates, then there'd be more buyers and opportunities. People would be, they would feel better about things. So, and obviously, the more the rates go down, the more people want to put their home on the market because they know they could buy at a lower rate than 8%. So,
yes. Yeah, and there's a lot of people that I know I've talked to that had thought about selling, maybe downsizing, but it wasn't going to save them any money. And in fact, in some cases, they were going to be spending more money on the smaller house than what they were currently paying on their current house, even though they had a ton of equity to cash out and make a huge down payment on the new mortgage. And it's just that weird place that we're in because of where we had unprecedented low mortgage rates. Those types of rates had never been seen before. And I know I was telling you before we started this that, used to be, as I'm a real estate agent, so when people finally ask me questions about the market, well, where are home prices? Where are people moving? What seems to be selling right now? The question I get the majority of the time right now is when I find I'm a real estate agent, he goes, well, where are mortgage rates at right now? It has nothing They don't really care about
Hmm.
the housing market. They just want to know where mortgage
Yeah.
rates are, which is interesting because I know many of us, when we first bought our home, we weren't asking where mortgage rates were as far as relatively speaking. It was just what are rates at? Okay, what
Right.
can I afford at that rate? Okay, let me go look and buy a house
Right.
in that price range. But now it seems people have this
Right.
mentality that if the rates aren't where I want them to be, then I don't even need to buy. Like I don't even look at what I can afford because
Right.
I just don't want that rate.
Right.
No. Um, well, like I said, we'll try to keep it short for you. Hope this information was helpful and interesting, and hopefully gives you stuff that you're not getting through the normal channels. Because we try to keep things very local and very relevant and out and real. Yeah,
And real.
yeah. We can give you kind of the
Local,
uh,
relevant, real. That
absolutely
should
and
be
tell
our
you what we've
headline.
been experiencing on the ground. I know I've had many buyers and
Hmm.
sellers just agree they're not going to do anything until after the first of the year, which is odd. I mean,
Yeah.
people don't. Some people go, I don't really do it during the holidays, but it's just kind of like everybody was out looking. Then everybody decided I'm not looking anymore until after the first of the year or rates drop. So it's definitely a
Yeah.
different time, and for many reasons, also
It is for
outside of our
sure.
control. Well, any closing thoughts, Josh?
Nope. We just, appreciate you guys jumping on to watch these and hope the information is helpful. We're here. We're fighting for you guys on our side. That's what we're here for. So we know it's tough, but hang in there. Silver lining is still around the corner,
Yep.
so it'll be
Yep.
here before we know it.
All right. Well, that is it for this video. You will hear back from us collaboratively again, probably after the first of the year. We'll do a year-end combined video,
Yeah.
and you'll probably hear from me. I don't know if that's positive or not. Next month, I'll give you a quick local real estate market update next month. So thanks, everyone. It's Friday, so have a great weekend, and we'll see you next time.